Welcome back to the channel. Today, we're diving into a topic that's been on everyone's mind lately, the Federal Reserve's latest economy warning. With all the talk about inflation, interest rates, and the possibility of a recession, it's crucial to understand what's really going on in the economy and, more importantly, what it means for your finances. In this video, we'll break down what the Fed's warning actually says and how it could affect everything from your savings to your investments. So if you're looking to make smart financial decisions in uncertain times, stay tuned and don't forget to subscribe for more updates. What is the Federal Reserve and what does it do? The Federal Reserve, often referred to as the Fed, is the central banking system of the United States established in 1913. Its primary role is to manage the country's monetary policy with the goal of ensuring economic stability. It is often seen as the backbone of the U.S. financial system because it influences interest rates, regulates banks, and helps control inflation. At the core of the Fed's mission is maintaining a balance between promoting maximum employment and ensuring stable prices. To achieve this, the Fed uses tools like interest rates, open market operations, and reserve requirements. These tools are employed to influence the amount of money circulating in the economy, directly affecting inflation and overall economic activity. One of the Fed's most well-known actions is adjusting interest rates. When the economy is growing too fast and inflation is rising, the Fed may raise interest rates to cool things down. This makes borrowing more expensive, which can reduce spending and investment. On the other hand, when the economy is slowing down and unemployment is rising, the Fed may lower interest rates to stimulate borrowing, spending, and investment, encouraging economic growth. The Federal Reserve also plays a critical role in bank regulation and supervision. It ensures that commercial banks operate in a safe and sound manner and comply with the necessary regulations. This helps maintain confidence in the banking system and prevents financial crises. Another important function is managing the money supply. The Fed controls the nation's money supply by buying and selling government securities in the open market. This is known as open market operations and is used to either inject money into the economy or take it out, depending on current economic conditions. In addition, the Fed acts as a lender of last resort. During times of financial instability, the Fed provides emergency funds to financial institutions, preventing a collapse of the banking system. In summary, the Federal Reserve is essential for stabilizing the U.S. economy, influencing inflation and employment, regulating banks, and ensuring the smooth operation of the financial system. Why the Fed is optimistic about the economy? The Federal Reserve is optimistic about the U.S. economy due to several key factors that signal stability and growth, despite challenges like inflation and global uncertainties. One of the main reasons for this optimism is the strong job market. Unemployment rates have remained low and job growth continues across various sectors. When more people are employed, they have the income to spend on goods and services, driving economic activity. This is important because a healthy labor market helps prevent economic downturns and supports consumer confidence. Consumer spending is another crucial factor. Despite inflation, consumers continue to spend, especially in key areas like housing, retail, and technology. This ongoing demand for goods and services suggests that people still have purchasing power and are confident in the economy, which helps fuel growth. Consumer spending is a significant driver of economic growth, and its resilience provides a solid foundation for the economy. The Fed also looks at steady GDP growth as a sign of optimism. While the economy may not be growing at the same rapid pace seen in previous years, it's still expanding. This moderate growth indicates that the economy is not in a recession and suggests that economic conditions are stable. Slow but steady growth is often viewed as healthier and more sustainable than rapid expansion followed by sharp downturns. And despite inflation concerns, the Fed's actions to control inflation, primarily through interest rate hikes, have proven effective in slowing price increases. While inflation remains above target, the Fed's measures are gradually bringing it under control. which helps preserve purchasing power and economic stability. Lastly, the U.S. financial system remains strong, with banks well capitalized and better equipped to handle shocks compared to previous crises. A stable financial system supports investor confidence and ensures the smooth functioning of the economy. In conclusion, the Fed is optimistic because the economy shows signs of stability, low unemployment, resilient consumer spending, moderate GDP growth, controlled inflation, and a strong financial system. These factors suggest that the U.S. economy is positioned for continued growth. What this means for your personal finances. The Federal Reserve's outlook on the economy has important implications for your personal finances, especially when it comes to things like interest rates, savings, and investments. Firstly, interest rates are a key focus. The Fed has been raising rates to combat inflation, and this means that borrowing money becomes more expensive. If you have credit card debt, student loans, or a mortgage with variable rates, you'll likely see higher interest payments. It's a good time to focus on paying down high interest debt to avoid rising costs. Additionally, if you're thinking of taking out loans or making big purchases, you may want to wait or prepare for higher borrowing costs. On the positive side, the strong job market means many people are still employed and earning income. However, this doesn't mean you should become complacent. Building an emergency fund remains important to protect against unforeseen events. Even in stable times, it's essential to have savings to fall back on. For investors, the Fed's policies are likely to create some market volatility. With interest rates affecting investment returns, it's important to stay diversified. Don't panic during market swings and focus on long-term growth instead of short-term fluctuations. Rebalancing your portfolio could also help align it with the current economic environment. Lastly, savings should remain a priority. While inflation has impacted the cost of living, staying disciplined with a budget and cutting unnecessary expenses will help you save more. Building a solid savings cushion will give you peace of mind as you navigate any economic uncertainty. In summary, stay strategic with your debt, savings, and investments to adapt to these shifting economic conditions. Thanks for watching. I hope this video helped you understand what the Fed's warning means for your finances. If you found it useful, don't forget to like, subscribe, and comment below with your thoughts. Stay financially smart, and I'll catch you in the next video.